Hello and welcome to our virtual coffee talk, Insights into the Changing R&D Landscape. We just wanted to go over a few housekeeping items before the webinar begins. You will receive 1 CPE credit for attending the webinar, and in order to receive CPE credit, you must stay connected to the webcast for the entire program and answer at least 3 of the polling questions. And I think that's it. If Kevin,
great.
If you want to begin start the webinar.
Great, thanks so much, and thanks everyone for taking time out of their day to join us. You know, this month's virtual coffee talk is entitled "The Insights into the Changing R&D Landscape," and it's really true that there's been a lot of recent developments and things that we're actively watching, some of which we previously discussed, some of which are really new, and so I'm really excited that Kathleen King is joining us again. For those that haven't seen her present as part of the virtual coffee talk, Kathleen King is the National R&D Practice Leader at A&M, and so she is very active in this space, tracking everything. And as always, Kevin DeYoung is joining us from Wolters Kluwer, and he will show us CCH Answer Connect at the end and how you can utilize it to also keep track of all of these developments. As you can see, the agenda, things are so crazy, so hot topics that we have 2 number 3s, and really it's that busy. And why I say that is we're going to talk about the planning for Section 174 capitalization. And you know, if you're not aware of 174 capitalization, you're in store for a wide opening awakening of things to come, as well as new guidance for research credit claims. This was recent IRS guidance that came out, really controversial, poses a lot of questions, and so this is something that taxpayers are going to have to think about, saying, okay, well, what do I do? How can I make these claims? And then you can see there's updates on recent pending research credit cases, as well as the current trends in IRS audits, And so they really go hand in hand. You have these cases, you have the audits, what's going on with the service, how do they want to proceed, what do we think is going to happen going forward? And so with that, Kathleen, I thought it would be helpful if you give everyone a brief summary of the upcoming changes to 174.
Thanks, Kevin. So as Kevin mentioned, we have covered this topic previously, even on a coffee talk, but that was probably going back 7-8 months ago. And honestly, at that point in time, I think everybody was optimistic that by year end, we would have some sort of deferral or some change where we really didn't have to dig into the details here. But unfortunately, we still do not have a fix on this particular change. Again, this was something that came in with the TCJA Act back at the end of 2017. And we now are in 2022. It seems so far out when this first came about, but now we're starting tax years January 1st, 2022 forward. We do need to be, assuming that no change occurs, either to defer it a couple years or otherwise remove it from the books, we are in a position where we need to figure out how to do this amortization and what it means. So again, this is for effective tax year starting January of this year. And as a reminder, again, what's happening is historically, most taxpayers have been able to deduct 100% of their R&E expenditures. Starting with this change, there is now a capitalization requirement. The capitalization period varies based on where the R&D is performed. So for research performed in the United States, it's going to be a 5-year capitalization period. And for research performed outside the US, it's going to be a 15% amortization period. And again, this is one of many big changes. Again, historically, you haven't, never mind if you had to track the R&D expenses themselves for capitalization purposes, but now you're going to have to differentiate those costs that relate to US versus those that relate to offshore activities. There has been no guidance issued at this point in time to really help taxpayers grapple with what this means. And so I know that there's a lot of questions out there in terms of what costs should be included, how it fits in with some of the limitations from a exclusion perspective, both under 41 and 174. There's questions in terms of, is there, everyone's expecting that there is going to be an accounting method change required. Is it going to be automatic? What supporting information is required? And one of the largest changes, just to make sure people are focused on, is again, this doesn't just impact businesses that as a normal part of their activities, they're performing activities that would qualify for the research credit. Starting this year, all software development costs are deemed to be R&E in nature, meaning that whether it's an internal use software project, a software project for sale to your customer, it is now in scope for this amortization requirement. So it's really important that you focus on, again, what kinds of activities are taking place that may fall under that bucket. And again, the other thing to keep in mind is this is something that it doesn't go away. Once it's capitalized, it stays on the books for the 5 years. And it's really on the books for about 6 years because there's a mid-year capitalization requirement so that you take half of the deduction, half a year deduction in year 1, half the deduction in year 6. And so there's going to be a lot of tracking that's required for it. So as I indicated, again, there is still activity out there. We're still optimistic that this is going to be removed from the book. I think it doesn't make, from a policy perspective, from a business perspective, I think most parties, excuse me, agree that this doesn't make sense, but it has to be paid for and it has to balance all the things that Congress is dealing with. And I guess, Kevin, why don't you give us the latest in terms of what you're hearing in this area?
Right, thanks. And so last year we were talking about Build Back Better Act, BBBA, and the provision, as Kathleen was mentioning, in the BBBA sort of walks back this capitalization requirement. And so people took a sigh of relief saying, okay, we don't have to worry about the requirement to capitalize. This is sort of pushed on. However, as everyone knows, BBBA hasn't passed, and it's really unclear to what extent it actually will pass. The Democrats are currently now saying that instead of trying to pass one large package, they're looking to pass potentially smaller pieces, possibly separate. And so then you ask the question of, well, is that 174 piece going to be part of a package? And if so, which piece will that be part of? Obviously, many Democrats in the House are anxious about possibly breaking things up into slivers. And so really, it's not really clear what the Democratic path forward is to either delaying or reversing this TCJA change. You can note on the slide that we mentioned tax extenders, and the reason why is because there's also talk on the Hill for the possibility that they will try to do some form of a tax extender bill since they didn't pass any tax reform at the end of the year. Now, typically when you think of a tax extender, you're extending a provision. Here they would actually be delaying the implementation of a provision, and whether or not that would fit within the purview of a tax extender bill remains to be seen. Obviously, there is bipartisan support for addressing this issue, and so it's quite possible they'll try to pull it out and get bipartisan agreement on working on this. However, as 2022 is a midterm election year, it's not clear to what extent there will actually be bipartisan legislation coming throughout the year. So this is something that we're actively looking at. Obviously, all parties agree that 174 or the capitalization requirements that Kathleen just summarized should be delayed. However, until there's actually legislation doing that, unfortunately, taxpayers are left in the lurch. And so they're left saying, what do I need to do? How do I do it? And so with that, we're going to launch the first polling question, which again, reminder that you need to answer at least 3 of the polling questions. And the question is, do you think that Congress will revert to the pre-TCJA standard for Section 174 costs? Yes, but it won't happen until late 2022. No, it's here to stay. No, I think it'll be deferred again before the end of 2022. Not a complete reversal, but changes will be made. You know, while you're answering it, I did want to sort of note, you said, okay, Kevin, you said there's bipartisan support, so it looks good that there might be a change as far as 174, they're going to reverse it. I don't necessarily have to worry about it. Well, unfortunately, that's not the case, because many companies that are doing their first quarter provisions are going to have to take this into account until there's actually a reversal. This is not a proposal saying, okay, there might be a change in law that's going to implement this. This law has already been implemented. We're now looking for a change in law to reverse the implementation. And so that's really a key thing to keep in mind, that you have to factor that into first quarter provisions. You're going to have to possibly consider it for estimated tax payments. And so really, it's a matter of thinking about, how does this apply to me? And taxpayers should be mindful of that and start thinking about it now, as opposed to waiting until the end of the deadline and saying, oh shoot, this now still applies. Congress didn't act as I anticipated. While you're still answering the question, Kathleen, why don't we start talking about the research credit work papers and how they can leverage them?
Sure. So as Kevin said, we're now at a point, because there are a number of auditors that have already raised the questions with some of my clients that I know for sure, in terms of they're basically letting companies know that, look, like Kevin said, this is now a law. It's on the books. It's not something that we can ignore. You do need to have some sort of disclosure as of Q1. And so this is something that, again, even if, I mean, Kevin, I don't know if you have any thoughts in terms of if something is to go through. I'm assuming earliest that we'd be looking at is mid-March. Is that a fair assumption?
Yeah, that's the current signs, as far as like BBBA, possibly slivers passing sometime in mid-March. But again, if they get a quick slimmed down tax extenders package, it's possible that it could be sooner, but many people are saying that that's unlikely.
So given that timeline, it's going to be very challenging for companies to wait much longer, you know, maybe another month before really starting to dig into what this means for them for Q1. And certainly for those businesses that are currently claiming the research credit, we encourage you to, the best starting place is what you have currently reported for Section 41 purposes, because that's your floor. And so you know that your 174 that's your minimum. And so then you have to figure out what do you have to layer on top of that. And there's a couple of different things that need to be analyzed in making that assessment in terms of what needs to be changed for 174 purposes. The one is there are additional activities. There are specific exclusions that apply to the research credit that are not applicable for 174. The one that comes to mind immediately is foreign research, because again, the credit is intended to incentivize research done in the United States. But now for 174 purposes, those costs are going to come back in. And as mentioned earlier, they're going to fall under that 15-year amortization period to the extent that they are foreign research activities. Internal use software, again, another area that many companies have been hesitant to really spend a lot of time in for 41 purposes, because it does tend to be very contentious. There is a higher bar. There is no high bar for 174 purposes. So again, an area that, again, you probably just, for a variety of reasons, not spend a whole lot of time on, now is something that's going to be a particular focus that, again, trying to figure out what's potentially out there. And then there's a lot of questions with respect to funding and how that plays in to the determination of whether something is going to meet the 174 standard. That's a topic that's beyond the scope for today, but it is certainly something, if you perform research under contract, something that you need to be considering, whether there's a broader range of activities that need to be included beyond what you would for the credit. And then there's also the additional expenses, and that's what we're going to spend a little bit more time on today, because what's very clear is the salaries, the non-taxable benefits associated with your researchers, your developers, the direct facility, equipment, material costs. Those are fairly straightforward, that those need to be included. The question is, what more outside of what's included for 41 purposes and beyond are in play for 174? So if we look at the types of guidance that's available to help us identify what specific 174 expenses need to be included, again, I always like to start with the law and the regulations. What 174-2 says is all such costs incident to development or improvement must be included for 174 purposes. And there's a couple of words to dissect there. One is, first of all, it says all such costs. And so it clearly implies that it's a very broad range of expenses. And again, it uses the concept of incident to, which means that it's not just direct costs. So there is this contemplation that, again, you would be including both direct and indirect costs in that. It's interesting, if you look back at some of the guidance that came out for when 174 was just being proposed, when you look at the FAS 2, the ASC 730 guidance, so basically the financial statement guidance in terms of what is development, it talks about the fact that you must include an allocation. Again, this is for financial statement purposes. You must include an allocation of indirect costs, but then it says that general and administrative costs not clearly related aren't included. So again, it's drawing this distinction between, okay, what's an indirect cost versus what's a G&A cost. And I think that, some of that may be just based on how your organization defines those two particular buckets of costs. But that's one of the nuances that companies are having to grapple with, in terms of, if you look at not those that are directly associated with the research, whether it's from a cost center perspective, you're able to identify those costs. But what do you do with the broader range of costs that are outside? Because there's clearly a contemplation that there is some amount of indirect costs that come under 174. I think that one of the best starting points is to think about, again, is it research? Because again, if you look back to the language in both the statute and the regulations, it's incident to development. And so when you look at the activities, I think there has to be a question, all right, is this really relate to an R&D activity? Does it relate to a marketing activity? Does it relate to, again, a G&A activity, which perhaps does not need to be included? Does it relate to production? And if you can more accurately put those costs in one of those non-research buckets, then that's one way to think about how to carve up those particular costs. I think if you look at the 174-6 rules as they relate to specific exclusions from R&E expenses, again, this also helps paint the picture. It talks about that there's an exclusion for Q&A and testing. Again, we also have this concept for research credit purposes. Again, to the extent that it may be technical, it may be scientific, but if it is testing purely for Q&A purposes, to figure out if it's meeting requirements and it's not related otherwise to a development activity, that's a clear area that's carved out from Section 174 application. It also talks about the whole idea of advertising and promotion. And I think that where it gets kind of gray sometimes is oftentimes we find that the marketing department of different organizations can have a pretty heavy hand in involvement in the development process. And so where they may seem to fall under an exclusion for again, advertising or promotion type activity, there's at least a portion of their time that we can find is directly related to R&D. And again, trying to get to that nuance and figuring out, okay, I see the individuals, I see they're directly related. What other costs of that particular organization should be pulled in to the process? And Kevin, can you go back to the prior slide for just a moment? Because I did want to talk a little bit in terms of, what guidance is available to help you with this assessment in terms of, is it R&D, is it development, is it an expenditure that we're interested in? Again, I would certainly start with the 174 regulations. There's a number of examples in there that at least provide some framework in terms of where you should be identifying costs. There's a fair number going back to even the 1970s. So this is really from the old original 1954 standard of 174 that analyze whether costs, again, should be treated as 174. And there's several of these informal rulings that are focusing on software development. And these two rulings, there's one that was as recent as 2015 that came out that cited a ruling from 2002 that I think provides, again, some framework, in particular in the area of software development, in terms of what should be included or not included. And for example, there's some specific language in there that talks about how the selection and implementation of templates, so what we would think of as a configuration activity under these informal rulings, those are examples of things that, again, those are not development in the IRS's eyes. And so as you're looking at this from a 174 perspective, that those would be an example of activities that you would want to pull out of if you're doing an ERP implementation. Again, there's a big difference between doing the interfaces, any type of wrapper code, add-ons, custom code, versus just doing a mere configuration of activities. And so some of those guidance, those informal guidelines are helpful in terms of just trying to help frame up what is development versus what is not. And there's some court cases out there that go into a little bit more granularity in terms of some of the expenses that have been accounted for as 174 that I think might be helpful. So if we go ahead, a couple slides, Kevin.
Yeah, before we do, one thing to note is, as Kathleen mentioned, there's all this authority that we could possibly look at. One of the things that is also interesting is there hasn't been IRS guidance on this, obviously, as Kathleen mentioned, but the question becomes, how are they going to proceed if this provision stays on the books, right? In the sense of, are they going to even potentially revisit some of the determinations of, is it subject to 174? Because as noted from a policy perspective, they're trying to now limit the scope of this amortization provision. And so if it's an otherwise deductible expense, will they possibly issue guidance that says, oh, it may have been historically 174, but now it's not? And so it's really a matter of not only following what's going on legislatively, it's also a matter of following, okay, if Congress hasn't resolved it, is there ways that the IRS or Treasury are able to possibly narrow the scope? And the answer is yes, but it's not going to be a quick fix. So with that, we did get a few questions about that. So Kathleen, I'll turn it to you for conforming changes, because we've also gotten a host of questions on this.
So Kevin, one question for you that's on this particular slide. I mean, what have you heard? Because again, 174 guidance was finally added to the priority guidance plan last fall. And obviously that would be something that would be extremely helpful for taxpayers to help them with these interpretations, because again, it's, unfortunately, there's no silver bullet out there in terms of where a lot of these lines are drawn. And so without further guidance, taxpayers are in a realm of trying to figure out, what is available. So I guess, what are you hearing, if anything, from the IRS in terms of where any of these projects are? Are they still just waiting for Congress to fix this?
Yeah, so I don't have any inside information per se. Before I came to A&M, I worked at the IRS and was there with the implementation of TCJA. And so generally, the government, both Treasury and the IRS, try not to issue any guidance that could potentially be impacted by pending legislation. And so because we have this 174 provision that's in BBBA and Congress is looking at possibly changing it, it's quite possible that Treasury and the IRS may not be putting anything out until it's definitive whether or not the 174 provision will be remaining on the books, or if they'll find a way of doing it. That's not to say that they haven't heard the comments of people saying, hey, we need guidance. But unfortunately, the IRS and Treasury probably aren't going to issue any guidance until we find out what happens with BBBA or some signs on the extenders.
So a couple things on this slide. Again, we could spend a whole session just digging into some of these specific nuances, but just to make sure that in the past, it hasn't really mattered where those 174 costs have sat. So in other words, you could claim for research credit some costs that maybe were still part of an inventoriable item. They may have been still part of a capital asset. They maybe show up on the tax return on a salary and wage line, as opposed to specifically being identified as a 174 cost. In the past, that hasn't really mattered. Now it does. And so this is not as simple as, oh, I just take all my 174 costs and let me capitalize them and amortize them over the appropriate period by the applicable project. You have to be thinking about, especially if you claimed pilot models, prototypes on items that were sold to customers, there's now going to be other changes in terms of it may impact your inventory treatment for these costs. And there's inventory, again, number of different factors that that come into that. It's not a very simplistic change. So there could be other conforming changes outside of just the 174 realm that companies will need to be thinking about. And again, as you're doing this early assessment to figure out what the impact is, that's probably question number one that you need to think about. Are there other provisions that may be impacted by this? In addition, there is a change that's now in effect for the way the 280cc calculation is being made. And so that as you're doing even your research credit calculation, because the whole point of 280cc was they didn't want you to be able to take both the deduction and the credit, there's now a conforming change to that because you're no longer getting the full deduction in year one. And so again, even for Q1 calculation to the credit, there may be some impact there. The impact on state research credits. And this is the one area where I flagged there may be opportunity for you to enhance your research credit, because there are a number of states that the definition that they apply is 174, it's not 41. And so now you're going to have this broader range of costs in activities to potentially consider. And so that may be a benefit. And again, all this, it sure would be helpful if we had some guidance, but again, we're all waiting with bated breath to see when that's going to come out.
Yeah, and just to note, we've gotten a few other questions, right, as far as the interplay of 174 and other code provisions. That's the area that we're waiting for guidance on, in the sense of, well, how does this capitalization requirement apply to provisions that would otherwise allow that to be deductible, and what does one trump the other and whatnot, but also acknowledging the fact that this is going to be another area where there's going to be potentially a book tax difference, right? In the sense of there hasn't been a gap provision that has changed to conform to this 174 provision. And so really this is something that's going to have to be traced for that purpose as well. But being mindful of the time, we could be talking about 174 for the next few hours. Kathleen, there was some recent guidance on research credit claims, so I'm sure that they're going to want to hear about this as well.
Yeah, and this was a pretty big development, I would say. A lot of people in the practice in this area, such as myself, were caught off guard to some extent in terms of this guidance coming out. And the original release was this past fall, and it was a Chief Counsel memorandum that again talked about the treatment of R&D claims, so research credit claims. And it raised a lot of questions. I mean, the first of which is, what do they mean by a claim, and what specific activities fall within that realm? I think there's still some questions in terms of what's very clear is if you are filing an amended return that includes a research credit, that is a claim, and it falls within the guise of this new guidance. I think that and again, the intention of the memorandum was really to tell taxpayers, this is what we're looking for. And the few comments that have come out from the IRS in this particular area, what's very clear is that there is a sense within the IRS and Treasury that there was some abuse that was taking place in this area. And the purpose of this guidance is to curb some of this abuse. And there was a court case that was, I think it was originally held probably 2 years ago now, Harper versus US. And at the lower court level, what the court said was that the research credit was not a valid claim, and therefore they disallowed the claim. On appeal, that was overturned, but some of the guidance that came out from the court was, well, IRS, you haven't even said what a valid claim is. And I think that that was part of the driving impetus for this particular change. So now they're trying to tell taxpayers that are making these claims, this is what we think incorporates a valid claim. And there is a certain level of specificity that's required under this, that's contemplated under this. And some of the minimum requirements that are put out there is, first of all, and this ties into a couple of those court cases that we were talking about, is you do need to make sure you're being very intentional in terms of what your business components are. And why that's important is when we talk about this 4-part test, the definition of what's qualified research, it ties in directly to your business component. Those tests are supposed to be done on a business component basis. So it's very important that in the claims that are filed, the amended returns that are filed, that you're very clear in terms of what your business components are. And for each of those business components, and this is where I think really people kind of like, almost like, oh my gosh, what, seriously? It's because it's for all research activities, all individuals, all information, each individual sought to discover. It was a very broad ask in terms of, and again, this is through an amended return process that they're asking for this information. And again, I'm not sure we talked about it on the prior slide. This is intended to be effective for claims. So amended returns filed on or after January 10th, 2022. So these rules are now, again, what's out there in terms of what the IRS is looking for. And so again, as part of the amended return, they are looking for an indication of each of these particular requirements. In addition, they were asking for specificity in terms of the employee wages, the supply costs. Again, for smaller organizations, maybe this is not a big ask, but if you are a large corporate company and you have 100,000 researchers out there across multiple business lines where you have many projects, having to do an amendment that would meet the standard is very onerous. And so one of the things that was interesting, even with the additional claim guidance, is they welcomed comments. They asked for taxpayers to weigh in terms of what they felt was, if they had questions, what was appropriate. And so several organizations did comment on that. And in response to some of those comments and just more informal feedback that they got, the IRS did issue, and this is on the IRS website, it's supposed to be continually updated. So certainly encourage people to be, if you haven't looked at these yet, it's something to keep in mind. But they posted some frequently asked questions with respect to this claims guidance. And this guidance, again, was intended to maybe soften some of the specific requirements that were out there for the claims. And in particular, some of the things that they I guess softened a little bit is that instead of saying that, again, the original guidance was for all employees, for all business components, for all research activities. And again, a research activity is broader than a business component. And so if you think of it in the concept of kind of tasks, that's what they were looking for. So very granular level of information. They've now said that individuals can be grouped together as you're trying to talk about what information they were seeking to discover. And that makes a lot of sense, because if you're working on a particular business component, whether it's 10 individuals or 1,000 individuals that are a part of the team, generally speaking, they're looking to resolve the same uncertainties. And so the IRS has softened it and said that when you think about uncertainties, it's something that you want to apply on a business component basis. The other thing that they responded to in the frequently asked questions is they said that it wasn't necessary to identify by name each employee and their wage in terms of how that claim rolled up. And because there were some concerns from a PII perspective in terms of personal information, from a confidentiality requirement. Do we really want to be filing amended returns that's listing names? And so one of the I guess alternatives that the IRS has offered, that instead of including employee names, you can do it based on employee job titles. But again, at the end of the day, they want to see that, again, they're auditors, right? At the end of the day, they want to be able to tick and tie and understand where those numbers come from. But they did at least soften in terms of the level of information that they wanted on the as part of the amended return.
One thing just to note, sorry, Kathleen, is one of the FAQs that caught my attention was what's on this slide, which is if your R&D claim isn't perfected, you don't live up to that standard that Kathleen was talking about, then your entire refund claim gets rejected, not just the R&D portion of that. And so as a result of that, you can see on the slide, it's a matter of considering filing 2 different refund claims in order to avoid the non-R&D portion from being denied. Now that poses a host of administrative difficulties because you're now having 2 different amended claims. What do you refer to as the original amount and the like, and who knows how they're going to process the 2. But that's something that taxpayers are now faced with. And we did get a question here and just want to sort of answer it, which is, right now the guidance is only with respect to amended returns. There's no talk of this requirement being applied to originally filed return claims. There's questions as far as, well, if you file an original file credit claim, can the service request this information? It's possible. There's no suggestion. The IRS has publicly said, hey, we're really focusing on amended claims and refunds established from that. But this is an area where we're really staying tuned to what's going on. The other thing just to note is, as all FAQs with the IRS, is they're not binding on the service. And as Kathleen said, they could change at any time. You're not necessarily able to rely on them for authority. And so taxpayers are really left with, we're doing the best we can, but really this is an area that we're really tracking, because taxpayers are going to be in this state of, well, what do I do? What is the standard? Is it worth even filing the claims, knowing all of the administrative burdens that they're going to have to do? And if the credit is big enough, then the answer is obviously yes. But acknowledging and appreciating that the cost of obtaining the right amount of credit will be different, because you're going to have to go through these processes.
And a couple things I would add to that, Kevin, is that just even if you comply to the letter, you feel like, you know what, we have done what we need to do. The only thing you have done is you now have a valid claim. And if the IRS was to select it for a deeper examination, you would expect that are still going to be more questions asked, because they have not, they don't begin to address Is it direct support? Is it direct supervision? Have you, with respect to your business components, have you looked at the 80% rule? Have you looked at funding? I mean, so this is just to get it over the, the starting line in terms of, is it a valid claim or not?
And let's launch the next polling question, which is, do you believe your work papers are sufficient if your research credit is audited? No, the IRS requirements make it difficult. Yes, we're very diligent. Yes, but we expect the IRS will review them carefully, or maybe. And as Kathleen noted, there were a lot of comments that were out there. On the slides, we have 2 of them that were noted on top of saying it should be part of the regulatory process. So that way, there's notice and comment. So that way the public is able to really respond and provide thought. They've also said, hey, there's going to be these new burdens and there's uncertainty. And so really there should be further insights, further guidance on this before it just gets implemented. But again, this is a change that is already implemented. And so taxpayers that are filing amended claims to claim the credit need to be aware of that. Kathleen, while they're answering the polling question, do you want to start giving an update on recent and pending court cases?
Sure. So as many people on the call are aware, probably the last 24 months or so were fairly active from a court case perspective. There were a number of different decisions. I would say that if I was going to bucket how those court cases fell out in terms of the issues that they were addressing, contract research was a fairly common one. There were multiple court cases looking at the funding concept. Again, this is for the credit purposes, not for 174 purposes. So there was Tangle, there was Meyer Borgen Johnson, there was Populous, all in the research credit area. And depending upon the case that you looked at, they were evaluating the question on substantial rights and the question from a funding perspective. And again, don't have a whole lot of time to go into detail here, but in particular on MBJ, one of the things that I would suggest, which I thought was very insightful, is especially if you're in the midst of an audit and you're getting a lot of questions and the IRS is throwing this case out there as being something that would support denying the credits, look at the briefs, because I think that it was very helpful to look at in more detail the projects that were being summarized at a very high level in the opinion. And I know that I've had at least one appeal meeting, this was probably about 6 months ago, where they were at least starting to ask questions like, why would we apply some of these differently than or not apply them differently than some of the earlier decisions. So even appeals has started citing some of these cases. So just certainly something to make sure that you're aware of some of the nuances that have come out, because I would say in general, many companies have sort of felt like that the question of what is funded for research credit purposes anyway was fairly understood. I mean, Fairchild Industries went back to 1995 now. It's a case that's been out there for a while. It was substantiated by Lockheed Martin and others that came afterwards. But again, questions are pending. I mentioned earlier that one of the things that they're asking for claims is the business component designation. And again, this is something that for many reasons, it's really important to make sure that you're giving a careful thought to how you're defining your business component, because you have cases out there like UCC that would say, well, geez, that's a process business component. Process business component is different than a product business component. And that would have implications for supply costs that you're claiming for the credit. But there's, just in terms of making sure that from a measurement perspective, when you look at your wages and you look at your contract research costs, that again, how you define that business component is really important for internal use software purposes. Again, there's this concept that the size and complexity can create a technical risk. So you want to be careful that, especially in the IUS arena, you're defining your business component appropriately, because if you define it too narrowly, then it's going to make it harder to get to that size and complexity concept. Another case that came out last spring was the Leon Max case, and that was specifically, it was a little bit different industry. It was on, it was a clothing, fashion design concept. And so really the focus of that case in my mind was on, is it a technical activity or not? But if you read some of the specific quotes from that case, we can see how there could be potentially an expansion to how that case was interpreted beyond just the fashion and style kind of concept. And I guess one case that we're keeping a very close eye on is Little Sandy Coal. That's one that, again, I mentioned this on the upcoming slide, that we've started to see coming from the IRS, some IDRs that really seem to be, we call them Little Sandy IDRs because they seem to be trying to get to that 80% process of experimentation measurement, especially when you look at it from a cost perspective. I know there was some question early on of what was going to happen with this case. It has been appealed. The case was actually docketed this past November, and they've already updated the briefing schedule once. But as of right now, the Little Sandy Coal brief is due in March. The Commissioner of Revenue's brief is due at mid-year, and then there could be a response. So we're talking, it'll probably be end of year before, so late Q3, Q4, before there's any formal determination made. But we're all keeping a close eye on this because, again, we're already getting questions in this front. And so that.
Just while you keep talking, we're going to launch the next poll question. So being mindful of everyone's time, just as you can see, we've gotten a lot of questions on this. And it's really easy if you'd like to be contacted by I&M to discuss your company's R&D expenses or credits. Yes, no, not applicable. Reminder, you have to answer at least 3 of the polling questions. So with that, Kathleen, feel free to go back to Little Sandy Coal. I just wanted to make sure we had the chance to launch the question.
Thanks, Kevin. And I think we can go on to, I do want to make sure that we spend a few minutes talking about what we're seeing in terms of IRS exams. And I think that one thing that, again, is a takeaway on this call is that disputes are likely to continue. This is what we're seeing is a ramp up. We've heard from the IRS that the reason why they put out the claims guidance is because they feel like this has been an area that maybe has been a little bit abused and people are overclaiming. You see it in the fact that, again, it was added as an issue of note and coordination by the IRS, probably going back 2 years ago now. And so, and recent court cases have really put some questions on some long-standing guidance that's been out there, and clearly a renewed focus in particular on claims. And so the part of the takeaway here is, again, this is an area that is going to continue to get attention, and you want to make sure that you're thinking, well, first of all, get things on an original return. We've said that for years and years and years, that claims have not been preferred, but this just, emphasizes even more, especially if you're, it's easy for companies and losses, don't really care about it. But again, if you see that change coming, that you're going to be profitable, it will behoove you to not have the burden of complying with those claim standards. In terms of what we're seeing in the IRS, in terms of current audit techniques, I think one thing I would highlight is we've been seeing an increasing number of questions specifically on 174 costs. This seems to be partially a buildup, trying to get ready for 2022 in the event that things don't change. But I think the other thing that we've seen is that the IRS teams have discovered that if they challenge 174 costs, there could be implications beyond just the credit. And there can be, in terms of, to some taxpayers, in order to, manage the 163J limitations, have capitalized some of their R&D costs already so that they can increase their taxable income. And again, that's the IRS has said, well, geez, if we challenge that and all of a sudden we say that's not 174 and that it shouldn't have been capitalized, again, all of a sudden that income that's required is no longer available. Talked about the Little Sandy Coal. We've seen a ramp up in terms of, I mean, the IRS has always used stat sampling to try and evaluate claims. And again, these are claims on original returns or claims on amended returns. That's just how it's a common way for them to audit these. The one caution I would have is what we've seen is that we've seen issues with the way the stat samples have been designed by the IRS sampling experts. And the nature of these, sometimes it is literally mathematical problems. You look at the numbers, you realize, well, that doesn't total. They're already putting you at a disadvantage in terms of how they've structured their particular sample. We found that the samples themselves are not valid. So don't accept, I would really encourage everybody, if you're being audited and they're applying a stat sample, tell them that you want to look at it. You want to make sure that you're comfortable that it's, that it is a reasonable sample that's taking place. Because again, we're seeing that more and more. And then state audits, obviously an area on the rise. In particular, Texas is an area that has been very aggressive. We had mentioned earlier that with the claims for research for federal purposes, that you want to be careful to not get other amended return changes potentially caught up in that process. We've seen the same thing in Texas, where returns were amended really not primarily for research credit reasons, for other reasons, but the research credit claims process in Texas has kind of taken a life of its own, and it's derailed some claims for other purposes that are out there. So just be very thoughtful in terms of how those things are being included.
Yeah, and the only other thing I want to note for the audience is we've talked about, hey, this is what 174 says. We're all looking to Congress for potential changes. I would be remiss if I also don't know, right, as Kathleen mentioned, there's a lot of focus on this at the state level. And the reason why I'm noting that is when you're dealing with state law, there's a lot of conformity questions in the sense of just because they might roll this back for federal purposes, unless some states specifically adopt that, they will still have 174 on the books for state purposes. And so you might have, okay, for federal purposes, I don't have to capitalize and amortize it, but for state purposes, I might need to. And so really being mindful of not only watching what's happening at the federal level, but also at the state level. And so I guess I want to turn it over to Kevin to sort of show us Answer Connect. Thank Kathleen for all the insights. It was really interesting to hear the developments and what you're seeing. And so Kevin, show us what Answer Connect can do for us.
Thank you. Kevin, I just want to make sure, Kathleen, you guys can see my screen, correct?
Yep, and I see
Excellent.
Answer
Awesome.
Connect.
Awesome. Yeah, Kathleen, Kevin, that's some great information. It's an area that we're all going to be keeping an eye on. And really what I want to take just a couple of minutes here as we wrap up our hour with you is to talk about some of the things that we did with our CCH Answer Connect tax research platform. When we built CCH Answer Connect, we really wanted to focus on a tax research workflow. How best can we put together all the information that is required and necessary to complete a project without making the researcher having to guess where it's at or go to different locations to find it. So we're just going to take a couple of quick minutes here to take a look at this. We're going to start out by doing a research on the research and development. Just tie into the 174, as Kathleen and Kevin have spent a lot of time focusing on that. What I want to point out first of all is how we've started to compile information and present content to it, to the user. And as we did this, we also wanted to focus on the different type of research styles that were out there. Do we have someone who is focused on keyword searching? Is that how they get into the contents that they're looking for? Looking for more of that explanative information, overview of the topic, or is the user looking to go directly into a code section, assuming that they know that? And how best can we, again, present that content? So from this point, we've begun pointing out informations that are available to you as a researcher. The topic pages being that explanative content that will walk you through the concept. Kathleen covered a lot of information on 174. The presentation style of the topics is very, very similar to what Kathleen has walked through with us. What I'm going to do right now, though, is actually go in and grab my selected suggested search and run a full search on research and development to show you a little bit how you can get into this content. The very first piece that we have is those topic pages that we have covering the content. I'm going to go ahead and open that up, and let's take a quick look at how that research workflow has been put together within a specific topic page and how it will lead you to additional content. What you'll notice first and foremost, we've been talking about the pre and post 12/31/2021 content related to this topic. This topic page is actually going to walk you through what specific areas, depending on time frame you're looking at, are the requirements that you need to be aware of, whether it's pre January 1st or post January 21st. Without making everyone dizzy here, we'll scroll down a little bit, but again, here's some of the content we have available. I'm going to scroll down a little bit further as we walk again through the research process related to this topic. And you'll notice what we've come down to now is our code section. We're going to hop back into this in a moment, but again, the editorial team is pulling all of this information here together for you. We've pulled together client letters. If you need to do some sort of communication on the change with your clients, we have those available to you as well. Any smart charts that we have on the topic, practice aids. Again, this is information that has always been available as part of a research platform. Again, we've just tried to focus on that workflow. How can we bring all the information together to you as the researcher to make you the most efficient we can as part of this process? We've added our news. If there's continuing legislation, cases coming out, these are going to be posted out here in our news section. We again wanted to bring this information to you. I'm going to hop over really quickly and take a look at our code section. There we go. Sorry about that. And again, this is where we focus very, very hard on what that tax research workflow looks like. If you'll notice across the top, we have a bunch of tabs. We actually entitled this our 360 view, that complete circular view of all this content, where we've put together the code section in its entirety. What I do want to point out here is we do allow the researcher to toggle back between pre and post, old law versus what the new law is currently. So you have that ability. Kathleen had talked about some of the regulations. We also make those available for you here as well. All of the CCH explanations, so if you need to get more specific into the actual sections and subsections of code section 174, we have that discussion here for you. You'll notice, again, more discussion on the pre and the post. The cases, administrative guidance, and annotations. Again, Kathleen had mentioned some of the cases that are out there that are being legislated. You'll have visibility to those here as well. So a great piece of information. We talked a little bit about the tools on the topic page, but we've also brought those to you directly as part of this 360 view from the code section. One of the things that we ended that conversation with Kathleen and Kevin was, what is the impact at the state level? This is where we've taken, again, tax research as the workflow to the next level for you. So as you finished up your federal research project, you now need to take a look at the impact at the state level. In this case, we'll use California as our example. What we are now doing is giving you that high-level view of what is California doing in relation to Section 174. Have they adopted it in its entirety? Have there been modifications to it? What is their thinking? And it's, again, as Kevin mentioned, going to be very, very important in the coming months as we see if this is going to be upheld or changed at some level at the federal piece. And from here, you're able to actually launch directly into the California content and walk through step by step, again, using that 360 view for that content. One last piece I do want to touch before we wrap up our time here together is another way that we've presented this content to you, and it's via our news feed. One of the things that we worked very, very hard at is being able to take this type of content, specifically the expenditure deduction, and we've created what we call a client impact event. And we do this for any type of significant legislation, rulings, court cases that are going to have an impact on a large number of researchers. And we have now taken this news piece and made it actionable, where we walk you through exactly what this 174 was all about, the planning opportunities that are out there, if there's any effective dates, timings that you need to be made aware of. If there's any additional recommended content, again, we push you then into the primary source, practice aids, all of that information pulled together for you as part of the research process. With that, we've hit the top of our hour. I thank you for giving me a couple minutes to show this to you. Jill, can you please take over and present the final polling question to our audience?
Yes, our last polling question we have up is, can you see it? Okay, there we go. Our last polling question we have up is, would you like a more in-depth demo or further details on the resources and tools available in CCH Answer Connect? And we will leave this final polling question up for about a minute or so. And after the polling question concludes, that will wrap up our virtual coffee talk. There will also be a few quick survey questions following the webinar. And for anyone who answered 3 of the required polling questions, you'll receive your CPE credit within 2 to 4 business days. Other than that, thank you for attending our virtual coffee talk, and we'll leave that question up just for about another 30 seconds or so. And that concludes our webinar. Thank you.